Welcome back, everyone. Today on the Joseph Carlson Show, we're getting to that time of year again. Thanksgiving's coming up soon. Christmas is right around the corner. We see some of the Christmas decorations and lights going up. It's everyone's favorite time of year. The holiday season is officially here. At the same time, we have the Trump rally still in place. Tom Lee saying that it's going to be a year-end rally. Things are looking good. The stock market is at an all-time high, and investors are celebrating. It's one of the most comfortable times I've been through in the market. And I've been through a lot of different markets. Now, normally, I'm an optimistic person. I like when the market's going up. My portfolios are doing particularly well this year. So I like how things are going. I'm enjoying it. But I still feel the need. I feel the deep down need to play the role of Debbie Downer here. Just a little. Because I feel that we're getting close to something. I'm seeing signs of a market top. And in this episode, we're going to observe the Debbie Downer case. We're going to pour a little cold water on this, and I'll be giving you 5 different signs that we're getting close to a market top. Things that I've noticed in particular that give me pause and give me red flags. We'll be going through all 5 of them here. Now, we also have some news to get into. First of all, Target's having a rough day. Target dropped 20% after widely missing their earnings. We'll be discussing why Target is struggling while Walmart, Amazon, and Costco are all doing really well. We had the Mike Tyson, Jake Paul event that was less eventful than we thought it was going to be. There was also technical problems with the streaming from Netflix. It looked like this was going to turn out to be an utter disaster, but the stock price keeps going up. We'll be doing a little bit of post-analysis of what really happened with this event. Google is still under attack by the Department of Justice. They're looking to break up the company by splitting off Google Chrome. Now, there's analysts saying that they could sell this for up to $20 billion. We'll be looking at whether or not Google's really going to be forced to sell Google Chrome and how it's going to impact the company if they are. And then finally, we have a viral video here of Josh Hawley, congressional member, and he is skewering or grilling 2 different CEOs, the CEO of Visa and Mastercard. He's going over how they're big, bad monopolies. He's going over how much money they're making on interest of consumers that are in deep debt. And this clip that we'll be watching today clearly illustrates how the majority of people, 99% of people, including Josh Hawley, still don't even understand what Visa and Mastercard do. They're 2 of the biggest companies in the world. They're 2 companies seen by everybody, used by everyone, but almost everyone still does not know what this company does. They don't understand the product of Visa and Mastercard. They don't even understand who to blame for the problems. Now, we start off the main story with a big question of, are we getting to a market top? This is something that I've been thinking about for at least a couple of weeks now. When I look at some of the things going on, I can't help but notice that there are recurring themes. History doesn't repeat, but it rhymes. In this case, we see a lot of things happening now that we saw in 2021. And although it's not the exact same, it's not a carbon copy, I can't help but notice the similarities starting to creep back. It seems like human nature is always the same. We get into the same problems that we did just a few years ago. Now, again, I'm somebody that's optimistic. I don't have any problem with the market going up. I'm making a lot of gains this year. Most of my companies are doing exceptionally well. The portfolios are outperforming the benchmark this year. So I'm not a big bear. I'm not waiting with a big pile of cash on the sides, waiting for some epic collapse, and I'm frustrated about everyone else making gains. I'm one of the ones making gains right now. I'm fully invested. I have a lot of money in this market working well for me. But at the same time, I think it's good for investors to keep a grasp on reality, to stay grounded, to not get caught up into investor sentiment. Investor sentiment, by my judgment, is at an all-time high right now, meaning it's about as positive as it can get. All people believe right now is that the market's going to continue going up and up and up. And this is a general mindset that investors get in from time to time. There's no price too high to pay for a good company. Things are so well, the future's so bright that you're a fool if you have any level of skepticism whatsoever about a market rally. This is the type of positive sentiment that is now prevalent in today's market. We've had so much gains for such a long period of time that now we're getting to a point where we think we can't lose, where everybody thinks that they're just winning and winning. And I believe that that's a dangerous sentiment to get into. When I put together my personal investment philosophy, I outlined everything that I thought was the best way to invest, from stock selection to temperament to portfolio management. Lessons on what type of stocks to buy, when to buy them, and how to manage our temperament. Now, the temperament part is particularly important here. When we go down to that part here, we skip past different sections of this, we get to temperament. Good temperament is not getting excited when the market goes up, not getting sad or anxious when the market goes down, being patient and okay with being bored in the stock market, not needing to fit in with the pack. While on the other side, a bad investor temperament is someone that enjoys gambling, the thrill of winning when the odds are mixed, someone that is excited when the market goes up. Now, not just happy or content with their portfolio performance, but they're actively excited about what's going on with the market going up. The market going up means that prices are becoming more expensive. Most of us understand these lessons. We know what good investor temperament and bad investor temperament is, but it's still difficult to not fall into these traps, to not get really excited when all of your stocks are surging upwards. But it's still important to keep this grounded. When we look at the overall market and valuations of different companies, it's true that companies trade at different valuations, so your portfolio mix may be at a lower valuation than the general market, but overall, if we look at the general market, valuations are quite high. When we look at the S&P 500, that is this line right here. The PE ratio a year ago was 19. So a year ago, the PE ratio was below a 20. The PE ratio today of the S&P 500 on a forward basis, so this is forward PE, not trailing PE, it's still 24.6, almost a 25 PE ratio. That's much higher than the historical average of the market. When you chart this out over time, the S&P 500 typically trades between around 15 to 21, and now it's at a 25. This isn't the highest it's ever been. It's not at .com levels, but it's one of the highest points over the past decade, and it's certainly higher than the average. It's extending towards the higher end of valuation. When we look at the NASDAQ 100, which weights more towards those tech companies that everybody loves to invest in right now, the PE ratio, or the price to earnings we're paying over the next 12 months, is even higher at a 31 forward PE ratio. So whether we look at the S&P 500 or the QQQ, the major indices show that valuations are on the higher end. They're getting a bit stretched. You may argue that this is justified, that we have the Trump trade, we have deregulation, we have a more friendly government coming into place, we have Tom Lee on the internet saying that things are good right now, people are feeling good, unemployment's low, interest rates are coming down, so it looks like the perfect situation for stocks. And that may be the case, but either way, we're paying more for companies today than we did a year ago. And we're paying more for companies today by a huge extent than we did 2 years ago. As investors, we don't want to pay higher prices when everything is good. We don't want to buy the top price when the economy is perfect and conditions are as clear as can be. That's when you want to be more conservative. The time that we want to buy is when there's blood in the streets. When Warren Buffett says that nobody else wants to buy anything because things look so bad. That's when we want to be buyers of these stocks. I look at other videos that I've done in the past. One of them 2 years ago was titled, "Big Tech is Cheap." Very straightforward with the title of the video. The entire video outlined why I thought big tech was cheap, and I was buying into it to a huge extent. Let's rewind time and look at the prices big tech was trading for just a couple years ago. The first company that I outlined in this video as being cheap was Amazon. Amazon at the time was trading at $84 per share. Now Amazon trades above $200 per share just 2 years later. The next stock that I thought was cheap at the time was Apple, which was trading at $127. After Apple, I outlined Microsoft as being cheap. The stock at the time was $222 per share. Now it's $400 per share. And again, this isn't doubling over 5 or 6 years. This is doubling over less than 2 years. Then we have Google trading at $86 per share. I outlined that this one is just optically cheap and there's not even much to say about it. Google's stock price has since gone up from that $86 per share to now $175. After Google, I outlined that Meta is trading so cheap, it's being valued at near a commodity multiple. A commodity multiple means that the stock is being valued as though it's not going to either create nor destroy value for the shareholder. It's simply just going to coast along at its current state. And of course, that's not the case with Meta. It had ample upside. The stock was incredibly cheap just a couple years ago, trading at $128 and now it's trading at $560. I continued on with that narrative, pointing out cheap stock after cheap stock a couple years ago. Netflix was another one that I was pounding the table on, saying that you're selling off one of the best companies historically in the world, down 75% because of a small miss on subscribers. And that's the story during difficult times. If we rewind to early 2023 or mid to late 2022, that's a time period where nobody wanted to buy. All of these companies, even though they're optically cheap, and we'd love to rewind time and buy each of them, all of them had intense struggles. Amazon had negative free cash flow. It was talked about as a low-quality company with very low margins that was being beaten up by Shein and Temu. Nobody wanted to own Amazon when it was $80 per share. Everyone was making excuses. Every one of these had reasons that investors didn't want to buy the companies. They're concerned about one thing or another. The coast wasn't clear like it is today. But now that all these concerns have vanished and sentiment's at an all-time high, and there's no reason you wouldn't want to own these companies, all of them have raced up to all-time highs. So I think it's apparent that whether we look at stocks across the board or even individual companies, it's becoming more conclusive that stocks are at a higher valuation. And that's great when everything's perfect and the outlook is crystal clear, but as soon as we get a little bit of a rainy day, the calculation can shift. The risk reward for these companies was much better 2 years ago. That was a time to be buying in heavy on them. But now the calculation has shifted with the valuation. Now, that's not the only sign that I've seen that gives me pause that we're maybe getting towards the top. Another one is the reappearance of some popular figures during the 2021 epic bubble, namely Cathie Wood. She has resurged back onto TV. Just 5 days ago, we saw her face on CNBC, and I haven't seen her on CNBC for years. In fact, the last time was around 2021. So she's back on TV, now making appearances, talking about her fund, talking about her strategy, how it's going to blow your mind, how she's figured out stuff that other people haven't, giving crazy timelines, and she does what Cathie Wood always does best. She gives her never-ending 5-year predictions. Cathie Wood was at the helm of the 2021 bubble. She was leading the charge. Everyone followed into her when it was too late. And all the fools that bought ARK Invest at the very top, they lost out big. I tried to warn everyone. I made literal videos right at the peak. This one was released on the week that Cathie Wood's fund started to fall. The bubble finally popped. ARK Invest and all the inflated valuations and all the narratives started to vanish overnight. The fund fell 75% plus. It hasn't recovered. She's underperformed for the past 5 years by a dramatic degree, over the past 3 years, over the past 1 year. Even year to date, her fund is underperforming the S&P 500 and the QQQ. But yet right now, she's still making TV appearances, trying to get exposure and get assets under management. This is something that I've been warning about for time after time again. When these type of people come on TV and start to instruct you on what to do, when their history shows that they buy into every single bubble, you should proceed with extreme caution. This caused a lot of damage to investors over the past 5 years. And again, this is something that I warned about years ago. Here's a video 3 years ago where I talked about Cathie Wood's insane predictions on Zoom. And again, I think this is actually dangerous for some people to listen to if they don't know better. She's telling everyone that there's this big pot of gold at the end of this 5-year rainbow, that companies like Zoom will be worth 15 times more, and she's so confident of it that even her bear case has Zoom being worth more than it is now, when the bear case for any company should be that it gets disrupted by competition and it goes down in value. That is a reasonable bear case. But her bear cases are so optimistic that they would be more optimistic than most people's bull cases. And her bull cases are they're unbelievable, that these companies will compound at rates that you've never seen before. Another thing to keep in mind is ARK Invest's incentive structure here. The way that they get paid is not based on performance. They get paid their 0.75% assets under management fee, their fees that they charge for their ETFs. They get paid that money whether or not Zoom does well or doesn't do well. In 5 years, you'll find out, but either way, Cathie Wood is getting paid millions and millions of dollars for managing these funds. I've been warning about Cathie Wood for years, the horrible performance and strategy of her fund, the way that she burns cash of investors while collecting management fees that are very steep. And Cathie Wood has destroyed more wealth for retail investors than any other single investor in existence. ARK Invest has destroyed $14 billion in wealth in the past decade. But here she is making a reappearance. And likewise, many of the Cathie Wood-like people, the same content creators, the same people that did the same thing in 2021, are making a reappearance with her. So there's a couple things already that I'm noticing that are a bit of red flags for me when looking at the stock market. Another one that I'm seeing right now that just raises some suspicion is that the most popular guy across social media, trending across Reddit, Twitter, across Instagram, across all the stock forums, is the levered Bitcoin guy, Michael Saylor. He's the number one right now. He's the most popular. He's the one that everyone's talking about right now. Michael Saylor's entire strategy is to lever up and buy as much of a non-productive asset as possible. And although I don't have any issue with Bitcoin in and of itself, When I look at this, I notice that the returns are rather good this year. It turns out levering up on Bitcoin this year was a good idea. He's up 621%. I see stuff like this happening and I go, wow, that doesn't look normal. This seems like an abnormality. And I zoom out over the entire stock chart and I notice the only other time throughout the history that this has occurred, if we rewind 23 years, we get back to the only other time that Michael Saylor's fund has skyrocketed to enormous highs and it's had parabolic growth. And that was in March of 2000. Should we be concerned that the only other time we've seen this type of behavior was during the dot-com bubble? I don't know, but it does raise a bit of a red flag. The next indicator that I see that we may be nearing a top is that investors are willing to justify the valuation of almost any company despite any type of valuation. In fact, we're getting to the point that we were in 2021, where we're now talking about companies in terms of price to sales, which means multiples of their revenue. We've forgotten about profit. We're not looking at profit or profit margins. We're just looking at price to sales. In this case, we have some striking examples here. We have companies like CrowdStrike, which trade at a price to sales of a 24. That's really expensive in and of itself. On a PE ratio, you're paying nearly 100 times forward earnings to buy this company, but it's doing well. Continues to go up this year, up 40%. So investors are willing to pay increasingly high prices that are very difficult to justify by any type of reasonable traditional valuation. And of course, we have the most glowing example of this, one of the most followed, favorited companies on social media right now that has impeccable sentiment. Everyone loves Palantir right now. With a price of $61, it has a 132 PE ratio. But more importantly, if we look at just the price to sales, the multiple of revenue, it trades at a 50 price to sales. When the 2021 bubble collapsed, every stock that was trading above a 20 price to sales got completely decimated. Those stocks got destroyed the most. I vowed after 2021 that I would never buy a stock trading above a 20 price to sales. And here we have companies trading at a 50 price to sales, over double what I would consider the max that I would ever consider buying. That's the situation we're in right now. And again, these are the most loved stocks in the market. The next indicator that gives me pause is Buffett's cash pile. I've talked about this one a couple of times, but Buffett's cash pile is constantly growing over time. And that's not a problem in and of itself because, well, Berkshire's growing over time. So the cash that he keeps should grow relative to Berkshire's portfolio. But even when we benchmark the relative growth in his cash pile, benchmarked against the relative growth in the size of Berkshire, for example, the asset value or the book value of Berkshire, he has record amounts of cash even adjusting for the size of Berkshire. We look at this here with a post from Bloomberg. Right now, their cash position makes up roughly 25% of their total assets. That is a very high percentage. Normally, Berkshire is somewhere around 10 to 15%. So it's not just the case that it's growing in nominal terms, it's growing in percentage terms to the total size of Berkshire. The last time that Buffett had this much cash relative to the size of Berkshire was back in June of 2005. We had a recession and a 50% drop in the stock market 2 years later. Now, Warren Buffett may be more conservative or more limited in what he can buy, so maybe he's just naturally growing more cash, but this is also something that we didn't just see with Warren Buffett. I recently did a video outlining the portfolio changes of all the best super investors. We saw a common theme there as well. They're being very conservative, very disciplined with what they're buying. And most of them are not doing a lot of buys right now. Now, I could continue on listing red flag after red flag, but I think you get the point. Ultimately, sentiment right now is at an all-time high with investors. The coast seems clear, valuations are high, investors are justifying buying higher and higher valuations, and we're seeing a resurgence of a lot of the same themes we saw in 2021. Now, don't get me wrong, I'm not bearish, I'm not taking my money out of the market, but I am looking more cautiously. I'll be taking some gains in some companies that have traded up to very high valuations. You're probably not going to notice a lot of trading from me over the upcoming months, at least with the market condition like it is. I don't see, frankly, too many opportunities that are great. I'm going to still try to be as disciplined as possible, not buy into the incredible sentiment that's in the market right now, and look at things in the terms of valuation where I can get the best risk and reward for every company I buy. But don't be surprised if I'm a little slower in buying stuff than I typically am. Now with that, let's go ahead and move on to some news. Now the first news item here is that Target just reported their earnings today. The stock price is down a staggering 20%. So another huge plunge for Target, because they missed big on their earnings per share. They also missed on their revenue, and they gave soft forecasts. So even their guidance wasn't great. So this was like a triple miss. The worst situation for a stock. Now, to just say it was a big miss is one thing, but let's go ahead and give that context, a visualization here. If we look at the Qualtrim earnings calendar, which this is released to every Qualtrim member now. If you sign up, you can try this out. So we go to Target, we look at the earnings per share dot plot here, and you can see the earnings per share over time. Blue means that they exceeded their expectations from the analysts. Red means that they missed. And we've seen some big misses throughout their history. But this most recent quarter is right here. If we look at the estimate, we can see the extent that they missed. They were expected to report $2.30 in earnings. They reported $1.84. So a sizable miss, one of the bigger ones there. Target misses on their earnings per share around 30% of the time. So this is not a company that I would consider predictable. Now, why is Walmart, Amazon, Costco doing so well while Target is doing poorly? I think the answer is pretty simple. They have different business models. The three companies, Walmart, Amazon, and Costco, focus primarily on value, the lowest prices possible. Target has shifted its focus to not the lowest prices, but the best experience. They have nicer plastic carts, they have Starbucks in their store, they have Ulta in their store, but their prices are higher than Walmart, Costco, or Amazon. And I believe strongly that the more enduring moat is low prices and better value. Ultimately, no matter what you do inside your store to make it a better shopping experience, consumers are going to gravitate to the lowest prices. I think it's going to continue to be difficult for Target to compete with these other retailers. Now, we also get to the news that last Friday we had the biggest live streamed sporting event ever with the Mike Tyson Jake Paul event. Now, if you missed the event, I don't think you missed much. The reason that I wanted to watch it was not for Jake Paul. I wanted to see Mike Tyson. I've seen him growing up. He's such a unique, weird figure in history, the best heavyweight boxer of all time. And I just wanted to see him pummel Jake Paul. That's what I wanted to see. That's what I think everyone wanted to see. And it didn't quite happen. It came out and it was a bit underwhelming. They went back and forth. Jake Paul was actually pretty respectful, which I liked. But overall, it was a very underwhelming event. And it was also laced with technical difficulties. If you're watching the stream, there's a good chance that you had buffering issues. The quality went down from crystal clear 4K down to like 720p. It looked a little bit more pixelated. It overall was not a great display from Netflix in terms of their infrastructure team. They have some work to do there. A lot of people said that this was a total disaster for Netflix. Netflix boasted that this was the most viewed live streaming event of all time, with over 65 million live concurrent streams, which is incredible. That amount of concurrent streams, meaning people viewing at the same time, is insane. And total streams of 108 million. So at least 108 million people or families checked it out. Each of them probably had multiple viewers there at the same time. Just a massive event. Like I predicted, this is going to be something that everybody hates, but everybody watches. That's the type of event that Jake Paul throws. Everyone hates him, but everyone continues to watch him. It's a recipe that he's figured out. They also pointed out that one of the women's undercard fights had 74 million total views, making it the most watched professional women's sporting event in US history. And this large social scale and impact that Netflix can seemingly leverage at a whim is what investors seem to be paying attention to. Because ever since the fight, Netflix stock has been up every single day. Every subsequent day has been another record-breaking day in Netflix stock price. Now Netflix is up 87% year to date, and the stock price is nearing $900 per share. Now we move on and we get to news that I hate to see. The Department of Justice is looking to break up Google, and their remedy, their solution for breaking up the monopoly Google, is to force Google to sell off Google Chrome, the browser. Google has created the world's most popular browser, and it's key to Google's ad business. The company is able to see activity from signed-in users and use that data to more effectively target promotions. So even though Google Chrome does not in and of itself generate any revenue, they're not making any money with Google Chrome. It's just a tool that they use to enhance the overall experience of using the other various Google products. So this is something that is vertically integrated. It's something that Google created to make the overall web experience a better experience. And part of the reason that I don't like this news is because I think Google has done an incredible job at perfecting the web browser. Should a sale proceed, Google would be worth at least $15 to $20 billion. Even if we take the high end of that, $20 billion, that's still only around 5 or 6 months of Google's free cash flow. In fact, it might be even less than that. So Google has worked on Chrome, perfected it, poured enormous resources into it over the past decade to enhance the overall experience and have it as part of their vertical integration. In fact, Google Chrome is so well liked by users that the top search in Microsoft Edge or Bing is download Google Chrome. People go to the defaulted web browser on Windows and they immediately search to download their favorite browser, Chrome. That's how well liked it is. And the Justice Department wants to force them to sell off this asset for a few months worth of free cash flow. Something that they can't really sell off for a lot because it doesn't generate any revenue. This is not a remedy that's good for Google, and it's not a remedy that's good for users. In fact, if they force Google to sell this off, they're not going to let another big tech company buy it. So it's going to be another smaller company that will want to make money directly from Google Chrome. So it will go from a free browser to one that has a mechanism of monetization. Google Chrome will start making money off of its billions of monthly users. So I don't see any upside for either users or Google. I don't think this works to break up Google's monopoly. It just makes an overall worse experience for the customer. And Google's going to be fighting this for years to come. Now, finally, we get to the news story that both Visa and Mastercard, two of the biggest companies in the world and two of the most known name brands in the world, sent their CEOs to appear in front of Congress to go through the ritual of having the congressional members try to make big sound bites and grill the evil CEOs that are making a lot of money for their shareholders. That's the tradition in the US. But watching this, reading the comments, reading the social media outrage, reading the hundreds and hundreds of comments left by people, reaffirms something that I've known for a while. And that is that no matter how big a company is, no matter how well known the brand is, most people still have no clue what the business actually does, what the products are, what the services actually are. They simply don't even understand how it works. You may be saying that, Joseph, that's impossible. I understand how Visa works. I understand how Mastercard works. You might be one of the few, but this is very apparent that most people do not, even members of Congress. Here is Senator Josh Hawley, and he's talking with the representatives of both Visa and Mastercard, explaining first and foremost how they're big bad monopolies because they have a combined market share of 80% and they don't want any competition. But then he moves on to a different topic, highlighting that he has a different understanding of how these companies work than the reality. Let's go ahead and just take a listen here.
Let's talk about what you're doing to consumers who hold your cards. Last year, as I understand it, there were 726 million Visa and Mastercard credit cards issued in the United States. That's about 2 for every 1 person in the United States of America. Do either of you know how much debt is owed on your networks, Ms. Kirkpatrick?
We're not the bank, so we don't have visibility into that information. We also don't generate revenue from interchange.
Oh, okay, you have no idea. Mr. Sheedy, do you know?
I don't know.
Let me help you out.
This is a strategy by Congress. He knows what he's doing. Josh Hawley is very good at doing these kind of like interrogation, cross-examinations. He makes both of these people look like fools. You guys don't know. You don't know what the current interest rate is and how much you're making off of interest rate. Well, Linda Kirkpatrick gave the correct answer there. She was spot on. She answered accurately. She said, we're not the banks. Visa and Mastercard don't make money off of interest. They don't give out loans. And no matter how many times Josh Hawley brings up how much interest consumers are being charged, how much debt there is on these networks, she continually reminds them over and over again, that's not us. We're not the ones making money from it. We're not the banks. But yet Josh Hawley uses this tactic to conflate these companies with the banks.
$1.17 trillion is what consumers now owe on your credit card networks. Do either of you know what the average interest rate is on your networks? Ms. Kirkpatrick?
Oh, Senator, we're not the bank. We don't set the interchange.
I know,
we don't set the
benefit
rates
from it, and you know. Do you know what it is? This is your business model.
We don't collect revenue from interest rates.
Do you know?
I don't, Senator.
Once again, Linda gives the correct answer here, reminding him that we're not the banks. We don't make money off of interest. You're pointing to us as if we're the ones profiting off of this trillions of dollars worth of debt, and we're not the ones making a profit from it. This is one of the most misunderstood aspects of Visa MasterCard. And what we see here from a senator is an attempt to conflate Visa MasterCard with the banks, either from ignorance or an intentional attempt to conflate these things to try to paint these companies be worse than they are. With this level of misinformation and misunderstanding, I think it's good to clarify a few things here. First of all, Visa and MasterCard are not credit card companies. They don't issue credit cards. They don't make money based on how much money you spend on interest on your credit card. None of that is part of their business model. Banks issue credit cards. You got your credit card or debit card by going to a bank, signing up for it, and they're the ones that gave you the card. When a bank decides how to issue a credit card, they of course need to go with a network that connects customers and merchants back to the bank. Otherwise, how do they connect with every other merchant out there in the world? They have to decide upon a network. When they're going through and deciding upon a network, obviously they want to use the one that is the most proven, has the best protections, the best reputation, the most uptime, and of course, the biggest networks. They want to have access to the most merchants and customers possible. So they typically go with one of the big guys, Visa and Mastercard. Those are the most ubiquitous, most used, most regulated, most protected, most insured, and best reputation networks. So the banks choose to go with them, they sign up for their network, and all that Visa and MasterCard do is link together the merchants with the customers with the bank. They take these three different parties and they network them together in a payment processing network. That's all the company does. Visa and MasterCard actually don't charge customers a lot at all. In fact, on a typical $100 purchase, Visa or MasterCard might only take 14 cents. They're only taking a tiny fragment of the actual purchase. The majority of the money made here is from the banks themselves, because unlike Visa and MasterCard, the banks are the ones that are extending credit. They're the ones actually giving you a loan. When they do this, they do make money on people paying interest on these credit cards, but that interest accumulates back to the bank. Visa and MasterCard don't see any of that interest. If we lived in a world where Visa and MasterCard didn't exist, that would mean that the banks would have to make direct connections to every single merchant and customer themselves. Of course, that would be more expensive, more cumbersome, and ultimately more expensive for the customer themselves than Visa and MasterCard specializing in it. So this amount of anger and resentment towards Visa and MasterCard is completely misdirected, and ultimately it works to misinform people about their business model. So if you're still under the mistaken opinion that just because a company has a known logo like Visa and MasterCard, the company must be accurately valued because everyone understands their business model, well, don't be mistaken. Most people have no clue what these companies actually do. That's all for now. See you in the next one.